Welcome back, everybody. The Investment Committee ready to answer your questions. And Tiffany, you get the first one. Jay in Florida writes, I want to buy either Square, Tesla, or Twitter. Which of the three would you buy currently, or would you wait and hold until any of them dip? What do you say, Tiff?
Yeah, so Square and Twitter, I would wait and hold and buy in the dip. I own all three, and I love them for different reasons. I have conviction around them. Square and Twitter, I do believe there's, of course, we're going to see some increased volatility. So those are good ones to buy in the dip. They're crushing numbers. But then Tesla, you have that crazy Elon Musk factor. They created and owned the luxury EV space. I would say I would love to buy this at a cheaper price, but it's just so hard to call that dip on Tesla. Even today with the news of that kind of soft recall, it's almost seems bulletproof. So if you love Tesla, just go ahead and buy it.
Just go ahead and get in for the long term. Let's go to Greg in Chicago, who writes that Generac is about 22% of his portfolio. It's currently my largest holding, he says. I think the company has great potential over the next 5 to 10 years. But when does a single stock become too much of a portfolio? And how too much? And when does it throw a portfolio out of balance? Joe, that one's for you. That's a big hunk, 22%.
Well, Tyler, fortunately for Greg, Generac is trading at an all-time high, so he's got the ability to pivot at a nice valuation here. But Greg, you're going to need to pivot. You're going to cut that at least in half. I want you to get down below 10% immediately. Doesn't mean I don't believe in the company. This is a company that is offering a solution to the instability in terms of the power grid, and it's also providing a secondary storage capacity as we electrify vehicles. So residences are going to have power generation backup. It's going to be provided by companies like Generac. They're also on the commercial industrial side. But Greg, let's get that back to a more reasonable portfolio, holding below 10%. Is
10% or below basically a benchmark for you? It's not just on Generac, but generally speaking, you wouldn't want one security to be more than 10% of your portfolio. Do I interpret you correctly?
That's correct, Tyler, but I'll share this with you. Where we are in the equity valuation for all the indexes, I actually believe that an equal weighted strategy happens to be the right one. And the S&P equal weight is outperforming the S&P total return year to date. So I like an equal weight strategy, but if you're going to abandon that, I don't want to go above 9%.
All righty, Rob, here's one for you. Anthony in New Jersey, where there are, folks, a lot of Anthonys. With a long-term view, he says, there are names where I feel like I can take profits and in buyback or trim. Is this a good strategy for someone managing retirement money, or is the buy and hold strategy the play to follow? What do you say, Rob?
Well, concentration is the key to building big fortunes. Diversification is the key to keeping them. If you're in the wealth building phase, as long as you can trust, as Ronald Reagan said, and verify that the thesis is intact, I don't mind holding a large position. We've done that with Microsoft, while Amazon, we've trimmed a bit. So I think there's a little bit of room for both as long as the thesis still holds.
And he seems to be saying there he wouldn't mind selling and then buying back. You just got to be wary of the wash sale rule, right?
Not in a retirement.
Not in a retirement portfolio. You don't have to, because
that's what he was talking about. And successful investors trade around their positions all the time. It happens to be much more effective in a retirement account because there's less friction cost to doing so.
Okay, great. Thank you for correcting me on that, Rob.